Just when I thought I knew mortgages, now they throw at me this notion of mortgage modification. What in the world is that? Well, first, I think it's always important to start off with why it's important for us to know, because it's tested on the bar. A couple questions that have recently been released talk about a mortgage modification. And if you look at your commercial outlines, you'll see a snippet about mortgage modification, but I think it makes sense for us to kind of look at what the law is, how you're going to see it, and give you an approach for a question dealing with a mortgage modification. I want to buy a home. I can't afford $1 million home. I need some financing. I go to bank number one, lender number one, and I say, hey, give me the money so I can buy my house. They give me some money, great, I'm happy. Now, if I don't pay, they're not going to be happy. Well, if I can't pay $2,000 a month, can I pay the $800,000 that I still owe them? No. So what does a bank do? Does a bank say, well, that was a bad loss, that was a bad bet? Absolutely not. They foreclose on the property. Wait a minute, how are they foreclosing on the property? Can they do that? Absolutely they can do that, because they took a security interest in the property. So I have pledged the property as security for repayment of the debt. So if I don't pay, if I go into default, they foreclose. They're going to squeeze the money out of the property that I promised to pay them in that original note. But everything's going great, job is good, getting my money. In fact, going to expand the family. We're going to have another child, and we need to make the place a little bit bigger. Instead of moving, we're just going to grow the house, right? We're going to put a second floor on. Well, I don't have, the $125,000 that I need to build that. Now, in real life, I'm probably going back to the original bank. That would be the easy thing. Oh no, not on the bar exam. They're going to make you go to, or your homeowner's going to go to a second bank. And the second bank is going to say, I know the house is already pledged as collateral for repayment of the original debt, but the homeowner's been there for a couple years. They've been paying down the principal, and therefore they've been increasing equity in the property because it's in a good neighborhood, good schools, low crime, people want to live there. There's a couple new industries that are moving into the area, so things seem to be good, and home prices are increasing, so you're worth a risk. And we will lend you, the second bank says, we will also lend you money for your home improvement product or your home improvement project. Great. Everybody's happy. First bank doesn't really mind. Second bank feels that this is a good risk because the homeowner is has shown that they are paying back their mortgage. They have a good job. Everything's great. But then there comes a time where the homeowner, right, the mortgagor, fails to pay. Boom, they go into default. Now, both banks are going to want their money. Both banks are going to try to line up. And I remember growing up in a home where dinner would be put on the table, and you needed to be there when dinner was put on the table because there was a limited amount. So you got your plate, and you were first in line, and you got your food. And then the second person, then the third person, and then the fourth. Well, depending on how much 1, 2, and 3 took, if you're fourth in line, you may not be getting anything, let alone, what you would like to have. So it was really important that when it was time to eat, you were standing there at the table. And that prioritization is the same thing with mortgages, right? Because bank number one wants to have its primary spot. Bank number two is likely going to be in second place. But they knew that going into it, right? Because they were aware of bank one's mortgage. But what happens when bank number one, right, the senior encumbrancer, modifies their mortgage? They're going to change their mortgage somehow. Well, what does that do? Just like the dinner table, it's kind of like, hey, number two, look at me. I'm getting my plate. Oh, and by the way, I'm going to fill up a second plate, giving even less for you, pushing you further back in line. Well, clearly number two and number three and number four are going to have a problem with that. So the junior mortgagee is going to say, hey, this is unfair, and they shouldn't be able to get seconds, right? That modification shouldn't get paid out until after my portion has been paid out. So really what the junior interest is arguing is it should go the original mortgage, then the junior mortgage, then the modification to the senior encumbrancer. The senior encumbrancer wants to argue, nope, it goes mine. and then yours. How do we know if it goes that way or if it goes mine, yours, and then the modification? Well, what we're looking for is a material prejudice. The junior interest is going to say, hey, this mortgage modification is a material prejudice to my interest. Now, you don't just argue that. You have to back it up. What are the examples of a material prejudice? If the senior mortgagee requires more principal to be put down, that would be a material prejudice. Or increases the amount of interest, the percentage of interest due. Now be careful. When my wife and I took out a mortgage on our home, we have an adjustable rate mortgage. So for the first 3 years, it's, 3.5. But then after the first 3 years, now it's called an ARM, right? Adjustable rate mortgage. Now it fluctuates based on what the market is. That's kind of risky for us, but hopefully it goes down and therefore we're not locked into a low rate for 30 years. My point being that if there's an adjustable rate mortgage, that was a contract provision that was entered into between the homeowners, right, the mortgagors, and the bank. So that would not be a material prejudice because that's really not a modification of the mortgage. That's just terms of the original mortgage. A modification would be where now the mortgagee says, we're just going to increase this to 4%. That would be a material prejudice. Some examples of what would not be a material prejudice is changing when the payment was due. Instead of it being due at the end of the month, now it's due halfway through the month. No big deal. The terms are the same. The material terms are the same. But here's the one I want you to look for. The percentage rate, right? The amount of interest being paid decreases. Like, why would it decrease? Well, here's the problem, right? The mortgagor says, oh my gosh, I lost my job or they put me to part-time. I don't have quite as much money, so I can't pay you everything, the $2,500 I owe every month. Could we bring that down to maybe $2,000? So there's going to be a refinancing by the bank. And the bank is going to say, fine, we'll let you pay a lesser amount each month, but instead of it being a 20-year mortgage, now we're going to extend it out to 25 years. That is not a material prejudice because, again, it helps the mortgagor, right? It helps the homeowner rather than hurts the homeowner. So when you see multiple interests in the same home, a senior and a junior or multiple juniors, and the senior interest tries to modify, make sure that your junior interest argues that there was a material prejudice. If there was, then they're going to maintain second place and the modification comes after them. If there wasn't, then they're not going to change positions and they will still be that junior interest. Watch for that one on the bar exam, my friends. Get yourself a point and it bodes very well for your confidence.